Hey, Claire here from Pitt News Magazine. Welcome back to Pitt News on Air. If you've ever heard someone say high-yield ETFs, specifically referring to the new Yield Max funds, if you hear them say they're just NAV traps, then this episode is for you. Today, we're taking on one of the biggest myths floating around trading circles. The idea that funds like Tesla, Misty, or PLTY just bleed out net asset value over time. Our editor-in-chief and my good friend Lan Turner decided to put a stop to this horrible rumor mill once and for all. He ran a real-world, side-by-side comparison using a historical backtest of Tesla versus just buying and holding the regular Tesla stock itself. Spoiler alert, the results are going to wildly surprise you. Get ready to rethink what NAV erosion really means, and why sometimes turning volatility into monthly income isn't just smart. It can be hugely profitable. Oops, did I just give away the ending? Here's Jake and Lena to break it all down for you. Hey, don't forget to stick around after the podcast. I've got a personal story I want to share with you too.
Welcome to the Deep Dive. Today, we're zeroing in on a subject that's getting a lot of attention, maybe some controversy, in the financial world.
Right.
We're talking about the criticism around yield max funds, specifically TSLY, the one linked to Tesla stock that generates option income.
And yeah, the core of that criticism, as I think many people listening will know, it really centers on this idea of net asset value erosion. The NAV keeps declining, and that leads some folks to call them NAV traps.
Exactly. So our goal today is to really dig into this, go beyond just the price charts you see online and the quick takes.
Yeah, get past the headlines.
We want to explore how these funds actually work, look at the numbers, and crucially, compare TSLY's performance directly against just, buying and holding Tesla stock.
And I think the complete picture might actually hold some surprises. It's not just about that NAV number.
Definitely. Okay, so let's maybe start by unpacking TSLY itself, just for anyone who needs a quick refresher.
Sure. So TSLY, it's a high-yield ETF, and it's directly based on Tesla's stock, ticker TSLA.
But here's the key difference, right? It's not just holding the stock.
No, not at all. Its main strategy involves options, primarily selling covered calls against its Tesla exposure. That's the engine designed to generate that, pretty substantial monthly income.
And that income isn't just sitting there.
No, it gets paid out directly to the shareholders every single month.
So basically, TSLY is trying to turn Tesla's famous volatility.
And boy, is it volatile.
Right. Into a stream of cash.
Exactly. The more the stock swings around, potentially, the more premium you can collect from selling those options. That volatility becomes the source of the cash flow.
Which is interesting because Tesla itself, the stock, doesn't pay a dividend, so this offers income from a place you wouldn't normally get it.
Precisely. It's a way to monetize that volatility instead of just writing it up and down.
Okay, so that brings us squarely to the main criticism, this NAV erosion.
Right, the elephant in the room.
And look, it's true. If you pull up a long-term chart of TSLY's price, the NAV, you will see it trending downwards over time. That's a fact.
It is. You can't deny the chart. But, and this is the crucial point, the decline isn't some sort of accident or mismanagement.
You're sure saying it's intentional?
Yes.
Yeah.
It's a direct result of what the fund is designed to do: generate and pay out large monthly distributions. That NAV decrease is the fund distributing value, taking profits systematically, and giving it to investors as cash.
So it's distributing the value rather than letting it accumulate in the NAV.
Exactly. For someone who wants income, that's the mechanism. It's a feature, not necessarily a flaw, depending on your goals.
Okay, so let's contrast that with the standard approach.
Yeah.
Just buying Tesla stock, TSLA, and holding it.
Right, the buy and hold strategy. With that, your return is all about the stock price going up. And those gains. They're just, on paper, they're unrealized until you actually click sell.
And yeah, we mentioned Tesla's volatility. Big swings up, big swings down. It's just part of the deal with TSLA.
And importantly for this comparison, holding TSLA stock gives you zero regular income. No monthly checks like TSLI aims for.
Yeah.
Plus, timing the market is hard. A lot of buy and hold investors might see huge paper gains, but then they don't sell.
Because they think it'll go higher, or they don't want the tax hit.
Right, whatever the reason. And then a downturn comes, and those gains shrink or disappear. There's no automatic profit-taking built in.
Okay, this sets up the comparison nicely. And you mentioned looking at a back test, putting them head-to-head.
Yeah, this is where it gets really practical. The analysis looked at taking, say, $100,000 and hypothetically investing it in TSLY versus TSLA over the same period.
And crucially, for TSLY, they didn't just track the final NAV.
No, that would miss the whole point. They tracked the NAV and added up every single dividend distribution paid out over that time.
Yeah.
That's the total return.
And for TSLA?
Just the stock price change, since there are no dividends to add. Simple capital appreciation or depreciation.
So what did the numbers show?
Well, the results were pretty striking, actually. Over the period they tested, the $100,000 in TSLY, when you combine the ending value plus all those dividends, it grew to $209,040.
Okay, so that's a total gain of $109,040 on the initial $100.
Exactly. Now compare that to the $100,000 just put into TSLA stock.
How did that do?
That ended up at $156,944. So a total gain of $56,944.
Wow, okay, so TSLY, despite the NAV erosion, delivered a much higher total return in this specific backtest, like almost double the profit.
That's what the data showed for that period, yes. The TSLY investor ended up with considerably more total value.
So why? What's the explanation for that? The material calls it forced systematic profit-taking.
That's a good way to put it. TSLY, because of its option strategy, is constantly generating cash from premiums and paying it out. Month after month. Doesn't matter if Tesla stock is up, down, or sideways that month, it's running its strategy and distributing the proceeds.
It's mechanically taking chips off the table, so to speak.
Yeah, it forces the realization of value. Now, you could try to mimic this with TSLA stock yourself, right? Sell a few shares every month for income.
But what's the catch there?
Well, if you're selling shares and the stock isn't growing fast enough to cover your withdrawals, you're eating into your principal. You're reducing your share count.
So you're eroding your holding in a different way. Instead of NAV erosion, it's share count erosion, potentially.
Precisely. Systematic cash extraction always impacts the underlying asset base, one way or another. The key insight with TSLY is that the NAV decline is the visible sign of that cash extraction happening. It's turning potential gains into actual cash in your pocket.
Which leads to what the analysis calls the real risk here, people just fundamentally misunderstanding total return.
Exactly. Focusing only on that NAV number is like looking at only one piece of the puzzle. You're ignoring the income stream.
The analogy used was like judging a farmer just by the size of the barn.
Right, the NAV.
Without counting all the crops they harvested and sold throughout the year.
To dividends, yeah. Total return is the barn plus the harvested crops minus what you started with. That's the full story. If you only look at the barn size, you might think the farmer had a bad year, even if they sold a ton of produce.
And the backtest suggests that, in this case, TSLY harvested more value overall.
When considering total return for that period, yes.
Okay, but let's be balanced. Are there times when that declining NAV is a genuine problem, beyond just perception?
Oh, absolutely. There are situations, for example, if you're using the investment as collateral for a loan, maybe a margin loan.
Right. The lender cares about the current market value, the NAV.
Exactly. A falling NAV reduces your borrowing power or could even trigger a margin call. That's a real risk.
What about a really bad market, like a prolonged bear market for Tesla?
That's another scenario. If Tesla's stock just keeps falling significantly for a long, long time, the option premiums TSLY collects might shrink and the distributions could decrease. And those smaller distributions might not be enough to offset the ongoing NAV decline caused by the falling stock price.
So the income cushion might not be enough in a severe downturn.
It's possible. The strategy relies on generating premiums, and severe, prolonged downturns can impact that. But, for many income investors, maybe retirees, the main goal isn't maximizing the final NAV decades from now.
It's about the here and now, the monthly cash flow.
Yeah, getting reliable income to live on. For them, systematic distributions might be seen as a major plus, even if the NAV drifts lower over time. It really comes down to your personal goals and your risk tolerance.
Makes sense. The source material also touched on a couple of other practical points, like that idea of mimicking TSLY by selling TSLA shares.
Right, and just to reiterate that point, selling shares for income also reduces your stake over time if the growth doesn't keep up. You might end up with fewer shares, less potential for future appreciation.
So pulling cash out always has a cost, whether it's via NAV decline or selling shares.
Fundamentally, yes. It impacts the underlying asset.
What about taxes? That's always a factor.
Definitely. The source mentioned that TSLY distributions are complex. They can be a mix of things. Yeah. Option premium income, sometimes return of capital, maybe ordinary income, potentially even qualified dividends sometimes.
And return of capital sounds good, but it's basically getting your own money back, right? Which lowers your cost basis.
Yeah, it has specific tax implications, often deferring tax until you sell, but lowering your basis. Option premium is generally taxed as ordinary income, which can be a higher rate.
Whereas if you just sell TSLA shares you held for over a year.
That's likely long-term capital gains, which often has preferential tax rates. So the tax treatment can be quite different.
The bottom line being,
Talk to a tax professional. It's really specific to your situation.
always good advice. And I liked how they framed it as myth versus fact.
Yeah, that was clear.
The myth. NAV erosion means you're losing money. The fact. NAV erosion is the result of paying out income. Look at total return.
Sums it up nicely. And the last point was about DREP, the dividend reinvestment plan.
Right, automatically reinvesting dividends. Why the caution there with funds like TSLY?
Well, think about it. If the fund is designed to have a generally declining NAV because it's paying out so much, and you automatically reinvest those dividends.
You're buying more shares at potentially progressively lower prices, but if the NAV keeps declining,
You could essentially be compounding losses, as the source put it. You're buying more of something whose price is trending down, funded by its own distributions.
so what's the alternative?
Be strategic. Take the cash distribution. Treat it like new capital. Then decide, is now a good time to buy more TSLY? Or maybe the underlying TSLA looks cheap.
Yeah.
Or maybe put it somewhere else entirely.
Don't just blindly plow it back in just because it arrived.
Exactly. Avoid automatically buying high if the NAV happens to spike temporarily.
Yeah.
Or buying into a sustained decline. Use the cash thoughtfully.
Okay, so wrapping this all up, the big takeaway seems to be this NAV erosion in funds like TSLY isn't automatically bad.
No, it's part of the design for generating that high income. The real performance measure isn't just NAV.
It's total return, the ending value plus all the cash you received along the way.
That's the number that tells you how your wealth actually changed.
And for investors who really need or want that consistent cash flow, this kind of strategy, even with the NAV decline, could be a valid approach.
It could be, yes. It serves a specific purpose.
So maybe the final thought for you, the listener, is this. Really consider how different investment strategies are built. Some are purely focused on growing the capital value over the long term, capital appreciation. Others are designed primarily to spin off regular income.
And understanding which of those aligns best with your specific financial goals, your timeline, your need for cash flow versus growth, that's absolutely critical.
Yeah. So maybe dig a bit deeper into that concept of total return and think about how these income-focused investments might or might not fit into your own picture.
Definitely worth thinking about.
Great discussion. Thanks for taking this deep dive with us.
Wow, that was interesting, wasn't it? Definitely not what I expected when I first started looking at a Tesla chart. A few months ago, I bought a little TSLY myself. I like the yield. I mean, who doesn't like cash flow, right? But then when my NAV, my holdings, started to drop, I'll be honest, I freaked out. I thought I was losing money. I almost bailed out. But then I talked to Mr. Turner, who completely flipped how I look at these funds. That decline I was panicking over, it wasn't loss, it was income. I'd been cashing out every month and didn't even realize that was the whole point, the reason for the NAV decline. That's why I love being part of Pitt News magazine. I'm still learning too, and I get to rub shoulders with the likes of Mr. Turner, Aidan Gray, David Duty, Dr. Scott Brown, Jordan Black, and so many other amazing traders. And I get to share my learning experiences here on Pitt News On Air every Wednesday. Honestly, it's become the best part of my week. I love it, and I hope you do too. So if you got something out of this episode, hit that subscribe button. I'll be back next week with another story, another lesson, and probably another small trading panic that I'll try to turn into a new lesson. And of course, make sure you subscribe to Pitt News Magazine at pittnews.com, because the articles that save my portfolio come straight from there. Okay, hold on. Did I save the file? Riley, no, not the keyboard. That's the third time this week. I swear, this cat trades better than I do. Come on, Riley. It's reward time. We earned a double shot espresso for that outro. Don't judge me, it's market research. Wait, is this thing still recording? Is that blinking light good or bad?